IAS 36 refers to assets. So we are focusing on assets alone, right? So we don't do impairment for liabilities and all that. We do impairment tests for an asset. Now, when it comes to an asset, you need to understand that our concern as maybe as in as an accounting standard, the standard setter, the concern is that people tend to want to overstate the asset, right? They want to show a better asset value in our statement of financial position, our balance sheet. Why? Because if I have a good asset value, then my business value will be higher, and when I sell shares, then I can sell it at a higher price, and I'll be able to get more cash in. When people, when I want to go in, the company is stronger. If I want to borrow money, then the asset value is higher. You can borrow more. So the tendency for people is for companies as a preparer. If you are from a preparer, if you are an accountant in the company, is you want to tend to have a higher asset value when you present your financial statements, right? Very few people will intentionally want to lower down the value of the asset. So most, as a rational economic person, you will tend to want to enhance the value of an asset. So from a primary user perspective, from a again also from a standard setter perspective, what we are concerned about is that when the company prepares their financial statements and they show the value of assets as 10 million, 100 million, a billion, or whatever, is it the true value? Is it a faithful representation, or is it overstated? All right. So we don't want it to be overstated. We want to know whether the value that is shown is really, because as I said last week, when you show an asset value of $10 million in the balance sheet, in the statement of financial position, it basically means that I should be able to extract out from the asset at least $10 million worth of either use. Okay, if I'm going to use it to manufacture products and sell, then I should be able to manufacture so many goods and sell it at so much money that it will at least fetch the carrying amount, right? The 10 million carrying amount here. Okay. Or if I want to sell it straight away, then like for example, if it is stocks, they want to sell it, then I must be able to sell it at a price at least the 10 million, isn't it? Because then no point, right? Then if the selling price is below, then I'm going to make a loss. Okay, so therefore that's why we do the impairment test. We want to see whether the asset is overstated in any way or not. We don't want that to happen, right? So that's essentially why we do an impairment test. Okay, so what is an impairment? An impairment, if you have an asset which is impaired, what it basically means is that the amount that you can extract out of the asset, the value that you can extract out of the asset, is less than its carrying amount. So there is a reduction in the usage and revenue that you can extract from that asset. And if there is that difference where the carrying amount is so much higher than the recoverable amount, then there is that your asset is actually impaired. Okay, because your asset that you show me at 10 million cannot really get 10 million. So it's an impaired asset. So an impaired asset will then have to be written down. Okay, so impairment of an asset is one way, one direction only. Okay, you cannot recognize. So if the recoverable amount is higher, doesn't mean that you can then recognize the profit. So we're not looking at that. All right, the intention of IAS 36 is not to look at valuation. Okay, because valuation will come in other standards. This standard here is looking for, are your assets overstated? That's all. All right, so is the carrying amount of your assets overstated? If they are, then we need it to be written down. If it is not, then it's fine. Okay, don't do anything if it's fine. All right, if it is not impaired in any way, then keep it as your carrying amount. All right, so that's what impairment means, and that's the intention of IAS 36. Now, you don't necessarily you don't jump into doing an impairment. Let me get real. You don't jump into doing an impairment. You actually, will look at your environment to see whether there are signs that an impairment has occurred. Only when you see that there are signs that maybe the assets are impaired, then you will go and do calculations, check on certain things that to see whether there is actually an impairment or not. So what are indicators of impairment is very important, right? So these are so there are external indicators that you find from outside of the company, and there's also internal indicators that you can do within the company itself. So external indicators, of course, will be your market price, can be the asset market price, or the products that you can generate the market price of that product. Okay, so is there a decline? If there is a decline, then no, yeah, maybe the asset, because if the asset is supposed to use to make certain products and the products prices are going down, that means there is a less demand, and if there's less demand, then the use of your asset will be less, and therefore your asset will no longer be able to fetch that higher value. So there will be an impairment, okay, or there may be an impairment. Yeah. So things like adverse changes in technology, in the market, in the economy of the country, and maybe even legal environment. Okay, so technology means that, is there any change in the technology that renders your asset now, not as useful as it was before, and therefore the recoverable amount, the amount you can extract from the asset is less, than what it used to be. Okay, so if someone now has a hard, so the obvious examples would be things like laptops, computers. Okay, if you are still using an old laptop, then there may be an impairment because new laptops are constantly coming. Okay, that is faster, that can store more information, can do it faster, and things like that. So also adverse changes in market. Is there a move away from one type of product to another type of product, right? So for example, many people are looking at more environmental friendly product. So if your company is still producing products that are not environmental friendly, then you will find that the value of your machines will be lower. So in that case in point, things like now in terms of straws, for example, your company may have machines that make straws, but there is a less, the market is changed for straws. People don't use straws anymore. Even if they use straws, they are looking at recyclable straws. So plastic straws are no longer in demand. Plastic bags, for example. So change in the market, change in the economic environment of the country, change in laws as well. If laws are prohibiting plastic bags now, so your machine that used to make plastic bags is no longer useful. Therefore, there will be an impairment in that machine. Okay, so that's adverse changes in technology, in the market, in the economy of the country, in the legal, in laws, new laws that comes up. Increases in interest rates. Okay, why is that an indicator of an impairment? Is because when we look at an impairment test, when we work out what's the actual impairment, what's the recoverable value, one of the methods we use is actually present value, because we project cash flows. So we will use discount factors. Okay, so as you know, you guys are graduate of accounting and finance. When interest rate rises, you discount at a higher rate. When you discount at a higher rate, the present value is smaller. So because the present value is smaller, the recoverable amount could be lower. And as a result, there could be an impairment. Okay, so that's the reason why we look at interest rates as well. And of course, this is quite similar to a decline market where the net assets exceeds the market capitalization. Market capitalization is your share capital of your company times the share price of the company. Okay, so that's the market value of your shares. Okay, this is more for when you're testing for impairment for investments in subsidiaries or investments in associate companies or other types of investments, right? So this applies then. But these are all external factors. Okay, whereas internally, there also may be indicators. For example, if you find that there are a lot of machines that are no longer usable, they are obsolete. Okay, then there must be some sort of impairment, or they are damaged in any way. Okay, through your own use, right? Material reduction in usage. So you can also, because it's sort of related, right? It's connected to the external. So if there's changes in technology, you may not use that type of machine anymore, or that type of asset anymore. So as a result, there must be an impact. There could be an impairment. Okay, and of course, again, worsening economic performance of your company, right? Your company is not making money, and it's constantly making losses. Then it may also be as a result of maybe your assets are not being used in the right way, and therefore the value is no longer there. Okay, so these indicators are very important, right? But remember, so the first thing the first step in an impairment exercise is first look for indicators. If there's no such indicators, then you don't have to do anything. You don't even have to you don't have to do any calculation, compare anything. Okay, so impairment review is done only if there are indicators or indications of impairment through external or internal factors, right? So only if you find that there are indicators that gives you a suspicion of an impairment, then only you go and do an impairment test or an impairment review. Okay, that's for the majority of the assets: property, plant, equipment, most intangibles. Now there are exceptions. Okay, so let me reiterate this. Yeah, so you don't have to do an impairment review if these indicators are not, there's no sign, right? There's no examples of these signs, except where it comes with intangible assets with indefinite useful life. So you have an intangible asset that has got an indefinite useful life, so you're not amortizing, all right? So remember, you're not amortizing it because you don't know what's the useful life. So those type of intangibles, you must do a test, a review, a calculation every year when you prepare your financial statements. Okay, so that's exception number one. Exception number two is that if you have goodwill that you have acquired, that arise from acquiring another company, your purchase goodwill. Like, again, you will find this more in the group financial statements. So if you have that purchase goodwill, then normally purchase goodwill, you have an indefinite life. Purchase goodwill, you will not be, so it's connected. Yeah, so goodwill that you acquire on when goodwill that arises when you acquire another company, normally those goodwill have indefinite useful life. You won't know when you use it up because you cannot see it. Okay, so as a result, you don't know what's to use, and therefore you are not allowed to amortize. So if you're not allowed to amortize, then again, you will have to do an impairment test every year. All right, so let me repeat this. Yeah, so normally in impairment test review is not done if none of these external indicators are there. Okay, you will only do it when there are signs, then you do an impairment review. Okay, the only exception is when you are dealing with intangible assets with indefinite useful life. For example, goodwill that you have acquired that arises because you've acquired another company. Okay, so please remember that very important requirement of the standard. Okay, Right. So now let's assume that there are indicators, right? So there are either an external indicator or an internal indicator that tells us that, maybe there is an impairment, right? So we don't know yet until we go and calculate that impairment. Okay. So what are we calculating when we are looking at whether there is an impairment loss or not? We want to look at the carrying amount versus the recoverable amount. Okay. Remember, the carrying amount of an asset will be its cost, not most of the time. It can be revalued, right? But then you have to less accumulated depreciation or amortization. Okay, so that would be your carrying amount. So if your carrying amount exceeds the recoverable amount, then you have an impairment loss. So you already calculate your carrying amount. You then need to calculate your recoverable amount. So how do you calculate your recoverable amount? Okay, so to calculate your recoverable amount, you calculate two values. If you can calculate them, you will calculate two values. One is the fair value less cost to sell. You should be familiar by now. What does it mean by fair value less cost to sell, right? So this fair value less cost to sell is explaining that you plan to recover that asset through its sale. Okay, so if you plan to recover that asset by selling it, then how much will you get in order when you sell it? So that should be your fair value. Remember, an exit value, not an entry value, because I want to know how much I can get, if how much I can recover if I were to sell. All right. So that would be a price received in an orderly sale between market participants. That means there should be an active market. There is a buyer and a seller, and the price is what is that? An efficient price, that everyone has full information. Nobody can cheat each other. The price is set at arm's length. Okay, so this is what we mean by orderly sale, not a forced sale. What's an alternative to an orderly sale is a forced sale. A forced sale means that when I want to auction off my house because I need money, so I want to get it sale as fast as possible, then that's an auction sale. That's a forced sale. That's not fair value, okay? Because that you may not get, you may not want to disclose all the information, and therefore your price, and also you may want to get the fastest price, right? And therefore maybe the cheapest price, not necessarily the fairest price. All right. So price received an orderly sale means that is in a market that is efficient. There's many buyers, many sellers. Okay. Less incremental costs to dispose. Maybe you have to send it, or maybe you have to pay commission or whatever to get it sold, or hire an agent or whatever. Then you minus off the cost to sell. All right. So fair value less cost to sell is the assumption that this asset that you have, I'm going to recover it through sale. So that's one way of recovering the amount. Now, the second way of recovering the amount is not to sell it, but to use it. To use it for what? To generate products that you can then sell. We call this value in use. Right? Now, value in use means that how much I can, when I use this asset, how much does it generate in terms of future cash flow for me, right? And that is the economic benefit. That's the revenue that comes in. So we measure the revenue in terms of estimated future cash flows. Of course, we may also have to have outflows, not just inflows, right? Because you may have to spend money. If you are making a product, you have to spend money to buy the raw materials, and then only you can sell. So what you're looking for is the net cash inflow less cash outflow. Okay, so you are going to project this future cash flows. And as I said, those cash flows are in the future, so you have time value of money, and then you have to discount it back. All right, so that's what we call the present value. So the present value of these estimated future cash inflows and outflows will be what we describe as value in use. And value in use is what we can recover from the asset by using it, not by selling it directly, but by using it to make products that we can then sell. All right. So we normally try and work out these two values, right? The recoverable amount would be either the fair value less cost to sell, which is the value I can recover when I sell, or the value in use, which is the present value of all the estimated future cash inflows and outflows, which is the value that I can extract from the use of it. Okay. Now, once you calculated these two values, what you do is you take whichever is the higher value, right? Not the lower, the higher. Why the higher? Because if you are an economically rational person, if you know that you can sell it at 10, let's say 100 ringgit, right? If you sell it now, you will get 100 ringgit. But if you use it to generate products, you can get 1,000 ringgit. What will you do as a rational person? Of course, you will use it because you are going to get a higher value, all right? But if you can sell it now and get 1,000 ringgit, but when you use it, you only get 800 ringgit, then why would you want to keep it to use it and not sell it now? All right. So that's why we use the higher of these two value, because if it's the higher of these two value, then you are likely to choose that option. If fair value is higher, you would sell it. If value in use is higher, I would use it. All right. So that's a rational thinking. That's based on, of course, economic benefits. Okay, not other benefits, because some of you will say, why would I want to sell it? I want to keep it, right? It's got sentimental value. So I'm not talking about sentimental value. I'm looking strictly at economic value. All right. So therefore, the recoverable amount would be the higher of the fair value less cost to sell or its value in use. Okay. So you will take the higher of the two. If this amount is less than the recoverable amount, less than your carrying amount, then you have an impairment. If this amount is more than the carrying amount, then you don't do anything. Everything is fine. There is no overstatement of the asset. We are happy with it. Okay, so there's no impairment loss, right? But if the carrying amount exceeds the recoverable amount, then you will have an impairment loss. Okay, and you will have to recognize it accordingly. A little bit more on value in use, because the value in use is the most subjective calculation, all right, between the fair value less cost to sell and value in use. The value in use is the one that is most subjective, right? And this is one that causes a lot of measurement problems or measurement challenges. Okay, why? Because they are projections. So they are what the management have forecasted that they are going to be able to use the asset. So if you're talking about, for example, a machine or a factory, for example, so you want to project that cash flow in future, then it must be based on management's projection. No other person can project it, because management will know what their plan is for that asset, what they are going to use that asset for. All right. So it's always going to be based on management approved budgets and forecasts. But that's always going to be areas where there will be subjectivity, right? Because management can be very optimistic. Okay, especially, so this is where ethics will come in, because if I'm forced to show, because if I don't want to have an impairment loss is not good, so I don't want to have an impairment loss, so I'll push my cash flow projections a little bit higher, so that it becomes my recoverable amount, which is then higher than my carrying amount, and therefore I don't do anything, right? So there will be a push to do that. There will be if the right threats are there, then there will be a tendency to want to do that. All right. So that's where the auditing of this is very critical. And how do you ensure that the projections are reasonable and you are able to rely on them? Okay. Now you shouldn't project it so you're actually looking into the future. So you can't look too far in the future, because if you look too far, it becomes even more uncertain and not reliable. All right. Looking too near, too short a time may not show the potential of using the asset itself. Okay, so the period, sort of like a compromise period where there is sufficient time and also not too long, will be a 5-year period. So the standard identifies a maximum of 5 years. You can use 5-year projections. You cannot use more than 5 years. Using less would probably be not beneficial to your company. Okay. And they were going to look at there must be reasonable assumptions. For example, you have to assume the growth rate of your revenue, which is growth rate of your price, volume of sale, what's the market like, what's the condition like, what's the inflation going to be like, what's the exchange rate going to be like. These are all unknowns that you will have to embed in your cash flow projections. And all these, there must be some assumptions. Okay, if it's if the environment is very volatile, then your assumptions may be not very reliable. All right. So these are the things that we have to take into account. There must be reasonable assumptions. Okay. And when you project, you must project based on the current condition and usage of that asset. The asset as it stands in the reporting date. How much can you use it for? You're not going to talk about things like if I'm going to change the engine or enhance it or overhaul it or whatever, right? We talked about overhauling it and things like that. You cannot talk about that anymore, because overhauling, it's something in the future, and we will do that impairment when you have an overhaul. All right. So it must be based on the condition of that asset as it is now at the reporting date. Okay, so please bear that in mind, that these would be some of the elements that results in the value in use being very judgmental, very unreliable at the end of the day. Okay, and there's also this problem or challenge with the discount rate, because we need to discount it because there is time value of money. Okay. There's also risk, because discount rates don't only take into account time value of money, but it also takes into account risk factor. Okay, the further it is, the longer your time period, then the discount may be even higher. Okay, so the discount rate, how you set the discount rate is very important. And the standard says don't use an after-tax rate, because the tax will then distort the cash flow. So use a pre-tax rate before any taxes. Okay, so there will be a gross amount before looking at taxes. So that's value in use, which is very subjective. Okay, so that's how you calculate impairment losses. But how do you recognize it? Where do you report impairment losses? So if you have an impairment loss, you charge it to the statement of profit and loss. Okay, so it will be charged out as an expense because it's a loss. So it goes to the statement of P&L. It don't put it to OCI or whatever, yeah, because this is not a valuation thing. This is really a check to ensure that your assets are not overstated. Okay, the carrying amount of the assets will also be deducted, right? Because it will obviously have a reduction in your carrying amount, and therefore you will affect your depreciation, right? Once you have impaired an asset, the carrying amount goes down, then you will have to allocate the carrying amount for the remainder of the useful life. And the useful life also may be changed, right? Because if it's impaired, you may not be able to fetch that long a useful life. So the useful life may change, and therefore your depreciation change. But all these will be treated as change in accounting estimates. All right. So this is not an accounting policy change. Okay. So that's how you treat impairment losses. Of course, if your assets have been revalued, then you follow back what you normally do under IAS 16 as well as IAS 38, right? So if there's a revaluation surplus before, then you write down the revaluation surplus first, and then the balance goes to P&L. All right. So that's in terms of the treatment of impairment. So let's look at an example to see how this is calculated. So in this example, we are talking about reporting date at 31st of December 2020. The asset of concern is an equipment, okay? So it had a carrying amount of $600,000 and a fair value of 400,000, and the estimated cost to sell that, to fetch that $400,000 is 20,000, right? You have to spend this in order to sell it to get 400,000. Now, if the equipment is not sold, then the value in use, right? It would generate an estimated cash inflow of 200,000 in each of the next 2 years. So you expect to be able to use it over 2 years. Okay. Now, assuming cash flows occur at the year end, that's very important because then you will know how to discount it. All right. So you need to know or assume when the cash flow arises. Okay. The risk adjusted discount rate for the equipment is 10%. Okay. So how do you treat it? And then how do you calculate the impairment loss, and how do you record that or recognize it? Okay, so essentially what you need to do is, because it's an equipment, it's a property, plant, equipment, and provided there are indicators, right? So obviously they would have been indicators of impairment. That's where you now jump into calculating the recoverable amount. So we all know that the carrying amount is 600,000. We now need to find out what's the recoverable amount. So what we do is we worked out the fair value less cost to sell. Fair value less cost to sell is the market value, the fair value less incremental costs to dispose of that asset. So that will be 380,000. Okay. In order to find value in use, so the cash flow that you project over 2 years will be 200,000 every 2 years at the end of each year, right? So each year you discount it by 10%. Okay, I presume you know what it means by discount. So you divide it by 1.1 to the power of 1 for 1 year, to the power of 2 for 2 years, etc., etc. Okay, so this would be, so 200,000 received in 1 year. The present value today would be 182,000 at 10% interest rates. All right, 200,000 received in 2 years' time. The present value today would be 165,000 with a interest rate of 10% per year. Okay, so you will receive these two over 2 year period. So your present value rather will be $347,000. So that will be your value in use. Okay, so what it means therefore is that for this particular equipment, if you were to sell it now, you are going to fetch this amount. You're going to recover 380,000. If you are going to use it for the next 2 years, you're only going to recover 347,000. So as a rational person, you think that you would probably want to sell it. That's our assumption. Whether you sell it or not is not important. That's the assumption, right? We're not saying that you're actually going to sell the asset, okay? But we are arguing why we are using the higher of this is because as an irrational person, that higher value would be more relevant to you. Okay, so therefore we take 380,000 as the recoverable amount. And then when we compare with the carrying amount, you see that this 600,000, this asset of 600,000 is not able to, you are not able to recover the full 600,000, right? You can only recover 380,000. So the difference will be your impairment loss. So your asset is overstated by 220,000. So you now need to write it down. Okay, so how you write it down will be you debit your P&L. Let's assume that there's no revaluation, nothing. So you debit your P&L, charge it out as an expense, as an impairment loss. You reduce your carrying amount of your equipment by crediting it to an accumulated impairment loss account, which is a contra asset account. All right, you will compare, you will then knock it off against your cost or your carrying amount of your equipment. Okay, so that's how you record. So when you show it in your statement of financial position under non-current assets, your PPE, the cost will be 600,000, less accumulated impairment will be this. So your carrying amount now will be equal to your recoverable amount. So there is no overstatement. So as a primary user, I am satisfied that the value, the carrying value as you report in the statement of financial position is reflective of the economic condition of your assets, right? In terms of what we can fetch it for. Okay, so that's the objective, and this is how why we treat impairment losses. Oh, yeah. Let me just finish this off by looking at an alternative where you had a revaluation before. So so the second part of this question says that what if you had revalued the asset earlier, and that earlier revaluation was the surplus, and therefore you recognize the reserve and you would have reported it under OCI, right? So if you have your same impairment loss, so your double entry now will be you write off against your reserve first, right? And then only you recognize the remaining loss into your P&L. Okay, so that's the only difference if you have done a revaluation before.